payments increased steadily in line with positive vehicle sales. Despite the increase in personal loans, household debt to disposable income declined further to 74.7% in the first quarter of 2012. Personal loans now account for 11% of total household debt, but have not led to excessive consumption expenditure. Formal sector employment creation has remained slow. According to the quarterly employment statistics of Stats South Africa, in the 4 quarters to the first quarter of 2012, just over 100,000 jobs were created, representing an increase of 1.2%. The outlook for wage growth is uncertain. Growth in nominal remuneration per worker declined from 6.8% in the year to the fourth quarter of 2011 to 6.6% in the first quarter of 2012. While unit labor cost increases declined from 5.8% to 5.7%. This trend may have been reversed recently. According to Andrew Levy Employment Publications, the average wage settlement rates amounted to 7.7% in the first half of 2012. And the outcome of the public sector wage settlement will be important in this respect. Administered price increases have remained relatively unchanged, but we still await nurses' determination of tariff increases to be granted to Eskom for the coming years. Some of the other important cost-push factors may have reached a lower turning point recently. Domestic food price inflation is still expected to moderate further in the short term, but the medium-term outlook is clouded by the drought-induced increases in maize, wheat, and soybean prices in the United States. This has already impacted on domestic prices of both maize and wheat and poses some upside risk to the inflation outlook. Brent crude oil prices also rebounded from their recent lows of around $90 per barrel, partly due to geopolitical factors. Currently, oil is trading at around $105 a barrel, well below the levels of almost $130 a barrel that prevailed earlier this year. And prices are expected to be constrained by weak global demand. The domestic petrol price has declined by a total of R1.40 per litre in the last 2 months, although a slight increase may be recorded next month. The MPC is concerned about the increased downside risks posed to the domestic economy from global developments. The problems in the Eurozone are likely to persist for a protracted period, and since the previous meeting, the negative growth outlook has spread beyond Europe, in particular to the United States, China, India, and other emerging market economies. The negative spillover effects to South Africa are likely to intensify. This unfavorable outlook is reinforced further by the fragile domestic private sector investment and consumption trends, which are confirmed by declining business and consumer confidence. The MPC therefore sees the risk to the growth forecast to be on the downside. The MPC also considered the inflation environment to have improved somewhat, notwithstanding possible pressures coming from food and energy prices in the medium term. Upside pressure on inflation could be offset to some extent by lower global commodity prices, while demand pressures are expected to remain muted. Although the exchange rate is likely to remain vulnerable to global risk aversion, the rand has shown some resilience in recent weeks. The MPC expects inflation to remain within the target range over the forecast period and sees the risks to the inflation forecast to be relatively balanced. In the light of these developments, the MPC views the prevailing conditions to be appropriate for further monetary policy accommodation to the economy that will not undermine the inflation outlook. The MPC has therefore decided to reduce the repo rate by 50 basis points to 5% from Friday, 20th July 2012. While it is recognized that such a move on its own will not overcome the challenges facing the economy, it is felt that it can help alleviate some of the pressures faced by some sectors. A sustained increase in the potential output of the economy will require a concerted and coordinated effort from both government and the private sector. The MPC will continue to monitor both domestic and global developments and will act appropriately in line with its mandate. Thank you. I'm happy to take any questions, and obviously my colleagues and fellow MPC members will also respond to questions that you may have. Yes.
Thank you, Governor. Mary Misa from Business Day. Was this decision to cut rates, which is somewhat surprising, I think, to many people, was it easy to reach? Was there opposition to the idea?
I think, as I've said before, Miriam, that there's no easy decision in the MPC, and this one was a particularly robust discussion. Because this is, I'm not sure that it's a surprise. I think that there's been a huge amount of comment, which we tend to switch off at a certain point so that it does not enter our discussions beyond. Obviously, we look at what markets are saying and what analysts are saying, but in terms of influencing our decision, that is something we shut out at a particular point. Yes, a robust discussion with pros and cons to the decision. But in the end, a unanimous decision that this is the right thing to do, that it's given the conditions that are prevailing and our concerns going forward, that we felt it was important to be proactive, and then a unanimous decision by the MPC to cut the rates by 50 basis points. Yes, sir.
Ed Stoddard with Reuters. Governor, I was just wondering from the tone of the statement, I'm just wondering, do you see the risks to growth as being greater than the risks to inflation? Thanks.
I think there's a question that, you often ask us, do we more weight on the growth issue or on the inflation issue? Our core mandate is the question of price stability. But in taking that decision, we need to take account of the environment that you're working in and that prevails. So, of course, we look at growth, and we have given you that our concerns are to a question of a deteriorating growth environment, not just domestically but globally. And it's not whether one weighs up more than the other. We're saying at this point in time, we see inflation being possibly affected in the medium term and by cost push factors, not by the demand side. And therefore, a question of saying we think it's appropriate at this point in time. It's not that we give more weight to one than the other. It's that in this particular circumstance, we feel that the issues of growth are important, the issues, as we've outlined in our statement. This is a very, very difficult environment globally, and we want to look at whether there are ways to minimize impact and spillovers to South Africa.
Governor Franz Wild from Bloomberg. Does your inflation forecast contain the rate cut that you've just made? And if not, how do you expect your move to affect the inflation forecast?
I'm going to ask colleagues to add in, so I don't know who would like to take that question. Monday?
Well, the inflation forecast that was presented to the MPC did not take into consideration the rate cut, the current rate cut. So it was change stance that was taken into consideration in the models. If that is, I'm answering your question correctly.
Yeah, no, absolutely. And I mean, how do you expect the inflation forecast to change given the rate cut?
Well, we'll see in the next meeting how the inflation forecast is going to change. We'll take this into consideration in the next model.
It's not a single factor that affects your rate forecast, your inflation forecast. It's a whole range of factors that we have looked at the different scenarios in that regard and to see how that will impact. Renee?
Good afternoon, Governor. It's Renee Volgra from Sunday Times. Governor, you mentioned that such a rate cut on its own will not overcome the challenges in the economy. But I want to know, referring to the fact that consumption expenditure by households seems to be slowing somewhat, do you expect this rate cut to have any effect on the way consumers spend and the rate of growth of consumption expenditure by households?
I think what we're seeing at this point in time is a repairing of balance sheets. So I would think that this rate cut, if you look at the decline in your debt to household disposable income, you're seeing a very significant decline, in my view, from around 82 to about 74, as we've pointed out. And I think what we're seeing from consumers is a conservative approach that is looking at repairing their balance sheets. This should help in terms of the cost of servicing debt. And if that continues, that can, whether they save, whether they look at how to reduce debt more effectively, if this contributes to that ability to service debt, then it is good in the medium to longer term for consumers as well. We're not seeing any